very realistic. I mean, especially if you have $10,000 gold, $200 silver. What is that? 50 to 1. I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist.
This is where things get exciting. Silver breaking above $40 puts the market right up against the same ceiling it has failed to break twice before, in 1980 and 2011, both times stopping near $50. That's the line in the sand. But here's the key: gold has already broken out. Silver hasn't. Yet. And historically, once silver clears a major resistance zone, the move that follows is fast and violent. If gold pushes toward $10,000, a number many analysts see as realistic in a global reset scenario, then $200 silver isn't extreme at all. At that point, the gold to silver ratio would only be about 50 to 1, which is historically normal. So yes, $200 is absolutely on the table. But the real action begins the moment silver closes firmly above $50. Once $50 flips from resistance into support, it opens an empty runway. There's no historical resistance between $50 and $100. Combine that with a heavily shorted market and limited physical supply, and you could see silver double in just a few months. This is the kind of setup where short squeezes, panic buying, and institutional FOMO all collide at once.
Gold was hanging out at 2,000. A lot of analysts put sell recommendations on Newmont and Barrick because they thought that gold had topped and they didn't see any upside. And then I think when Trump won, a lot of people expected the gold to fall because the economy was going to boom and Trump was going to do all this great stuff about shrinking the deficit, making America great again. But now it's becoming more obvious that none of that was true. But I think this is a new leg. We spent really over 10 years. Remember, the first leg of the bull market was 2001 to 2011. Gold went from under 300 to 1,900. So it increased by sixfold, right? Then it really went sideways from 2011 to 2024. Gold traded between 2,000 and maybe 1,500, 1,700. I mean, it initially pulled back to 1,000. It got to 1,050 in 2015. So it held 1,000, went back up, but only made a new high briefly during the 2020 COVID crisis. It poked its head above 2,000, but then, it got chopped off and it went back down. But that's a huge base that we built around 2,000 as a floor now, because it was resistance. It was the ceiling. Now it's the support. And now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1,900. Consolidation, that was a sixfold increase. If you assume we go up sixfold from 2,000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. And I think that there's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. And in fact, following the weak jobs report that we got today, and by the way, the jobs market has never been this weak outside of a recession. In fact, the last two times you had a labor market as weak as the one we got right now, it was the Great Recession of 2008, 2009 with the financial crisis, or 2020 as we were shutting the whole economy down because of COVID. So, the Fed has been mischaracterizing this labor market Powell kept saying we have a really strong labor market. We have a really strong market. He was wrong the entire time. We have a weak labor market. And you would even see how much weaker it was if we had honest statistics. But we don't. But even with the statistics we have, we had outright job decline in June. We lost 13,000 jobs in June. The August number was just plus 22,000. Manufacturing lost 13,000. And the U6 unemployment rate, which is more relevant than the headline rate of 4.3, is 8.1. So we've got rising unemployment and inflation. The Fed said that the labor market was strong, but inflation is weak. They got it backwards. The labor market is weak. Inflation is strong. And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down.
Gold's new bull run has already started, and almost nobody sees it. After breaking above $2,000, it climbed toward $3,000 quietly while analysts were calling tops. But that decade-long sideways range has now turned into solid support, the launch pad for the next major cycle. Weak jobs, rising unemployment, and sticky inflation mean the Fed is about to cut rates at the worst possible time. That's powerful fuel for gold and terrible for the dollar. Meanwhile, gold mining stocks are the best performing sector this year, up 30 to 40%, yet still massively undervalued because the public isn't paying attention. Even Newmont is beating tech stocks while being one of the least owned names in the S&P 500. Bottom line, this bull market has just begun, and most people don't even realize it yet.
I actually like the fact that this bull market isn't on anybody's radar because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin. All the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be. So we got a long way to go in the mining stocks. In fact, in April of this year, I kind of aggravated some of the guys at Schiff Gold because I put out this report that said the best way to buy gold, and it was to buy the gold mining stocks. And I was telling my clients for the first time not to buy gold. And gold was around 3,200, 3,300. And I said, look, I'm a gold bull. I love gold, but these gold stocks are so cheap that it doesn't make any sense to buy gold above ground. Just buy it while it's still in the ground because it's so cheap. And while gold went sideways for all those months, the gold stocks were soaring. And they're not as cheap as they were, obviously, but they're still very cheap. And I still think people should be buying gold stocks and gold now, and physical silver and these silver miner stocks. So, Schiff Gold is my gold company. What you want to don't do, there's so many, unfortunately, shysters in the gold industry. And they rip off their customers by pushing them into these numismatics or collectible coins, fake numismatics, proof sets, odd weighted, coins you've never heard of. And they do that because the markups are 30, 40, 50% or more. And so you need the price of gold to go up 50% just to break even. So why buy gold at 3,600 if you need 5,000 just to get out even? So at Schiff Gold, we're marking up gold like 1%. So if you bought gold yesterday, you can sell it back today and make a profit, right? So you don't want to get ripped off. So go into Schiff Gold, you're going to get the best prices. You're going to get just bullion. We're not going to try to push you into something that makes us money. We're going to sell you what you need to make yourself money. My goal is to make a little money on volume, not on ripping people off. But that's also interesting. Like Schiff Gold's phones are not ringing off the hook. I mean, it's slow, and that's the same throughout the industry.
What's happening in silver right now is exactly what a major breakout looks like before the rest of the world notices. We've already crossed above $40, and when you adjust the old 1980 high for inflation, silver would need to be close to $200 an ounce just to match its past purchasing power. So yes, $100 silver isn't just realistic, it's actually conservative if gold pushes toward $10,000. Remember, silver has not broken out yet. Gold has. Silver is still trapped below that historic double top around $50, first hit in 1980, hit again in 2011. That's the ceiling holding this entire move back. But once silver clears $50, the entire structure changes. Resistance becomes support. Shorts get squeezed. Liquidity dries up. And when that happens, silver has a habit of moving fast. You don't grind from $50 to $100, you jump there in months. And what makes this even more explosive? The lack of public interest. Retail investors aren't here. Phone lines aren't melting. There's no hype, no mania, and yet the metals are quietly grinding higher week after week. Meanwhile, the mining sector, the real leverage, is just beginning to outperform. The big names moved first, but the juniors, the tiny exploration plays with 5x, 10x, even 20x potential? They haven't even started receiving serious capital inflows yet. That's typical in the early stages of a commodity supercycle. So the irony is this: we may already be in a precious metals bull market. But almost nobody believes it yet. And when the majority finally wakes up, the price levels we're at today will look unbelievably cheap.